Good afternoon, everyone. Today is Friday. It's the 22nd of February 2013, and this is Brian Shannon from AlphaTrends.net speaking. Let's take a look at this market here. We'll look at the numbers first, and here we can see for the week the S&P 500 was down 0.14%. Nasdaq lost about 1%. Semiconductors were down the most here of the equities, and that was down 1%. But all in all, really, the market came back nicely, and we are still in a primary uptrend. Intermediate term support was lost here this week at this 151 and a half-ish area, and we can see that we got right back up to that level, through that level actually here today as the market recovered from the losses that began on Wednesday, I guess it was. Anyways, we are below a declining 5-day moving average, so that tells us the intermediate term we want to just kind of tread lightly here a little bit. We could be, perhaps slowing down the uptrend. That is, we've got if we take a look at a 65-minute chart, this kind of gives us a good feel for how this uptrend has been intact and how we broke that trend line this week. So breaking a trend line doesn't mean we've reversed to the downside, as I often point out. It does mean, however, that the market trend has slowed, and perhaps it needs to digest these gains, if not through by pulling back price-wise, at least through time. And if it does do that, again, we're still in this primary uptrend. We've had a really nice rally since December 31st when we were down at 140, and here we got up to 153 and change this week. We backed off of that. For the week, we did get back above the volume-weighted average price, which is impressive as well. And looking at the weekly time frame, we still have a pattern of higher highs and higher lows on the weekly time frame. We don't have a good pullback here, and eventually we're going to get one on the weekly time frame that could bring us down, down into 145-ish or so. Right now, the evidence isn't there for a pullback. All we have right now is some near-term caution as we're below a declining 5-day moving average. And I think that next week, the key levels to focus on will be really about 149.5 to 150. This is what's going to be the key band of support that we're looking for. It's impressive that this break of this support didn't act as resistance, but if we break back down through there and then stay below it, then I think that a test of 149.5 to 150 does appear to be likely. Again, we've got a rising 50-day moving average, and innocent till proven guilty. I think you just need to be a little bit more selective in your stocks right now. And as I pointed out earlier in the week, I had some questions, and they were good questions about, is it a time to start taking some profits? And I said, yes, it's if that's what the market tells us to do, that we want to listen to the message of the market. If we break down and start making lower highs and lower lows, then we want to listen to each stock individually. We don't want to, we want to get out of, Apple, for instance, a long time ago, as that pattern became lower highs and lower lows below a declining 50-day moving average. Anyways, back to the Nasdaq. Let's take a look in here. It was a little bit discouraging that the prior level did not hold, and that is, we had seen for much of the first month of the year that 67.50 to 67.80 had been the band of resistance, and we were holding above it until, that is, Wednesday. On Wednesday, obviously, we broke below that. Let's go back to a 65-minute chart again. Anyways, this was that band of resistance that we had seen form. And in here, it was having a lot of trouble with that. It seemed as though maybe we were going to be able to hold on. It got back into that range and then broke down, even down to the next level. And we came down this week and tested very close to the low for the year. The low for the year, I believe, was 66.17, and I think the low on Thursday was 66.25. We did also come down and test that rising 50-day moving average, so went slightly below that 50-day moving average. But the Nasdaq is really back to more neutral here again, and gives us a little bit more reason for concern that we are below a declining 5-day moving average. If we continue to rally up towards that, and then let's drill this down on a 10-minute time frame. If we continue to rally up towards that level and then see that we have a pattern of lower highs and lower lows again back below that 5-day moving average, then it's going to put the 50-day moving average in jeopardy, and perhaps we come down and close this gap. So the Nasdaq, not quite as we can't be quite as optimistic as we can be with the S&P 500. But again, breaking below 149 and a half in the S&P 500, I think we probably get a test of that 50-day moving average, and that might be preceded by a breakdown in the Nasdaq. So things are becoming more cautious here. This whole year, we've been focusing on the pattern of, as long as we hold each week, we've been saying these higher lows. As long as we hold above these higher lows, that we want to remain, looking at it and say, yes, the market is extended, but we're not breaking down. We're not showing any signs of slowing down until this week. We have seen those signs of slowing. We're not seeing any type of reversal or anything bigger to be concerned about, but we do have, a slowing in the market. The Russell 2000, if we look at the lows from November of last year, you can see that we came up and touched upon that trend line this week after this market's gotten quite a run here, and arguably a little bit ahead of itself, but the pattern was intact of higher highs and higher lows. We spoke about 91.50 being our first level that we wanted to see hold, and then below that of basically this 91 level. Well, we broke both below those levels on the downside, and although we got a rally back up in here today and regain some of those losses, we are below a declining 5-day moving average, and we haven't been below a declining 5-day moving average all year. We've been at this 5-day moving average that started to flatten out a little bit, but this is the first time we've had a declining 5-day moving average. So it pays, I think we need to pay attention to that and say, the key level here that we really want to see hold is about 88.75 to really 89 and a quarter. If we can hold 88.75 to 89 and a quarter on any pullbacks from here, then it will be just a pause within the uptrend. But if we then break down through that and stay below it, then we have to be a little bit more concerned about the trend ahead. The charts that you look at, and each week on Fridays, this video is brought to you on YouTube and at alphatrends.net via the generous support of Realtick. Realtick is the trading platform that I use, and it's what these charts are based on. So check out realtick.com and the brokers that they support for trading. So again, this is the bigger level we want to see hold in the Russell 2000. It's possible that this market kind of drifts sideways to lower, and the 50-day moving average kind of catches up with price action in that area as well. The semiconductors were down again. They were down 1 percentage point this week. They broke below that first level that we were focused on, which was $35.20, and you can see here late in the day it wasn't able to get back above that prior band of support. So we need it back above and closing above 35.20 to feel a little bit more comfortable with the semiconductors. If we take a look, we broke an important trend line in here as well and kind of battling with that level. So 35.20 to 35.30, let's just say, we need to see that this prior little band of support doesn't hold it back as resistance, because that could pave the way for another leg lower, which would bring it down towards about $34 a share, and that's where we see, of course, that we have that 50-day moving average as well. It's a good chance that we could see that 50-day moving average tested next week. We are below the declining 5-day moving average, so we're getting mixed messages on different time frames, and that means let the dust settle a little bit. You don't need to pick the bottom of a move. There's plenty of opportunity to get the meat out of the middle of a move. We don't need to get in at the bottom or out at the top. We need to listen to the message of the market. Depending on the time frame that you look at or how long you're comfortable holding, your time frames are going to be different. If you're an investor, maybe you're looking at the weekly charts and saying, hey, everything's still great here. I would look at this weekly chart though and say, it looks like after these types of rallies that it's probably due for some kind of pullback here, so some weakness wouldn't come as a surprise. But you have to be aware of all the potential scenarios and have a plan of action so that you don't get stuck believing, I'll go back to Apple again, that hey, well, it's a good company, I'll buy more at the 50-day moving average, or I'll buy some at the 200-day moving average, or whatever it is. Moving averages, technical analysis, they give us a visual reference point. They allow us to say here's where potential support or potential resistance is. It tells us when to pay closer attention for signs that the supply and demand forces may be changing. But it's not a reason to buy at a 200-day moving average. It's a reason to say, okay, let's get interested in here, and that's it. So, anyways, back to now the financials. The financials, as we know, have had a great rally. The weekly time frame, they're up at multiple year highs, and I've been saying for the last couple of weeks, it looks as though they're likely to get up towards $20 a share. I don't believe it's going to happen on this run. I'll still say that, although it may. The pattern of higher highs and higher lows on a daily time frame is still intact. We've got a rising 10, 20, and 50-day moving average, but obviously we get, this market got such a nice rally. They don't go straight up. We can see we broke a little bit of the trend line basically that's been intact since the beginning of the year. We broke that trend line and some support or an important level in here at about this 1775 to 1780 level. Now, it's not really, or I'm sorry, 1770 to 1775. We want to see that level hold this market up. Otherwise, if we start to find some resistance in here, in particular with this declining 5-day moving average, then it appears likely that the next area that this market should head down to would be about $17.30 in the financials. But we still clearly have a nice longer term picture. The point is, when you look at these shorter term time frames, well, when you look at the daily time frame with a stock that's extended up like this, you don't want to be buying blindly. Instead, you want to wait for the pullback and look for the opportunities where the market tells us it's time to get back involved. And right now, the market is telling us that we probably need to just slow down a little bit, let the market settle in. Hopefully, it doesn't turn into something like gold, which was a disaster for the longs this week. And, rightfully so. It was below a declining 50-day moving average. We had more repeated tests of support. The high, was making these lower highs below the declining moving averages. And this is what, this is the way markets are supposed to trade. I hope everybody has a good weekend. Come by alphatrends.net and check out some of the posts you may have missed during the week. And also, there is a section on there, favorite posts. If you take a look at that, there's a lot of great free educational content in there. And thanks for tuning in.